Private equity versus investment banking target. Two of the most powerful jobs in finance. Most people can't tell them apart. By the end of this video, you will. Investment banking and private equity. You've heard the names. You've seen the salaries. Maybe you've even applied to one without fully understanding what either actually does. These two industries sit at the top of the financial food chain. They attract the smartest graduates in the world. They pay generational money, and they are fundamentally completely different in how they operate, what they do, and who thrives in each one. Today, we're breaking it all down. What they actually do, how they make money, what the culture is like, the pay, the lifestyle, and most importantly, which one is right for you. What is investment banking? At its core, investment banks are advisors and capital raisers. They sit between companies that need money or want to do deals, and the markets, investors, or other companies that can make those deals happen. There are three main things investment bankers do: M&A, mergers and acquisitions. When a company wants to buy another company, they hire an investment bank to advise them. The bank values the target, structures the deal, negotiates terms, and gets it across the finish line. Think J.P. Morgan advising Disney on acquiring Pixar. That's M&A. Equity capital markets, ECM. When a company wants to go public, an IPO, or raise money by issuing new shares, investment bankers manage that process. They build the investor roadshow, price the offering, and distribute shares to institutional investors. Debt capital markets, DCM. When a company needs to borrow money at scale, not from a bank loan, but from the bond markets, investment bankers structure and sell that debt to investors. The key thing to understand about investment banking: they are fee-based advisors. They don't own anything. They advise, execute, collect a fee, and move on to the next deal. They are deal-by-deal machines. What is private equity? Private equity is completely different. PE firms are investors, not advisors. They raise large pools of capital, called a fund, from institutional investors like pension funds, endowments, and sovereign wealth funds. Then they use that capital to buy companies outright. Here's the basic private equity playbook. Step 1. Buy. Find a company that's undervalued, underperforming, or has room to grow. Buy a controlling stake, usually using a mix of equity and significant amounts of debt. This is called a leveraged buyout, or LBO. Step 2. Improve. Over the next 3 to 7 years, the PE firm works with management to cut costs, grow revenue, expand into new markets, make add-on acquisitions, and increase profitability. Step 3. Sell. Exit the investment at a higher valuation, either through an IPO, a sale to another company, or a sale to another PE firm. Collect the return. The goal is simple: buy low, improve, sell high. Some of the biggest names in PE, Blackstone, KKR, Apollo, Carlyle, manage hundreds of billions of dollars and own companies across every industry: hotels, hospitals, software, fast food chains. They're everywhere. How they make money. This is where it gets really interesting. Investment banking. Investment banks make money through fees: advisory fees on M&A deals, underwriting fees on IPOs and debt issuances, trading revenue. A single large M&A deal can generate tens of millions in fees. But there's no ownership, no upside beyond the fee. Private equity PE firms charge their investors two things: management fee, typically 2% of assets under management per year. On a $10 billion fund, that's $200 million a year just to keep the lights on. Carried interest, carry, the big one. PE firms take 20% of all profits above a certain return threshold. If a fund makes $2 billion in profit, the firm takes $400 million. That carry gets split among the partners. This is why PE partners become extraordinarily wealthy. It's not salary. It's ownership in the upside of every deal in the portfolio. Lifestyle and culture. Let's be real about the lifestyle, because both of these careers are brutal, just in different ways. Investment banking. Investment banking is infamous for its hours. First and second-year analysts routinely work 80 to 100 hours a week. You're building pitch books at 2 a.m. You're making last-minute changes to a model because a client changed their mind. Weekend work is standard, not the exception. The work is transactional and fast-paced. You're constantly switching between deals, industries, and clients. You develop incredibly broad skills: financial modeling, valuation, presentation, client management. But the depth on any one company or sector is limited. The culture at most banks is hierarchical and high pressure. You're at the bottom of a long food chain. Analysts serve associates who serve VPs, who serve MDs. The feedback loops are fast, the stakes feel enormous, and the burnout rate is high. Private equity is also demanding, but differently. The hours are still long, typically 60 to 80 hours a week, but with more predictability. You're not waiting on a banker's 2 a.m. call. You're deep in the weeds on a small number of companies. The work is more operational and strategic. You're thinking about a company for years, not weeks. You go deep. You sit on boards. You work directly with CEOs. The culture tends to be more collegial and merit-based, but the bar to get in is extraordinarily high. Most PE firms recruit almost exclusively from investment banking analyst programs. You usually need 2 years of banking first. The pay. Now let's talk money, because this is what everyone actually wants to know. Investment banking compensation analyst, year 1, $110,000 $130,000 base, plus $70,000 $100,000 bonus. All in, $200,000 to $230,000 out of college. Associate, post-MBA, $175,000 $200,000 base, plus $150,000 $250,000 bonus. Total, $350,000 $450,000. Vice President, $250,000 $300,000 base, plus $300,000 $500,000 bonus. Managing Director, $500,000 base, plus WEM 10 plus total comp depending on deal flow. Private equity compensation junior associate, similar to banking, $150,000 $250,000 all in. Senior associate, VP, $300,000 $600,000. Principal, $500,000 1M plus. Partner, this is where it gets life-changing. 1M 10M pluses per year, mostly from carry. At the biggest shops, senior partners make tens of millions annually. The ceiling in private equity is significantly higher than investment banking, but it takes longer to get there, and far fewer people make it. Which path is right for you? 4. Choose investment banking if you love fast-paced, deal-driven work across many industries. You want to develop broad financial skills early in your career. You're okay grinding hard for 2 to 3 years in exchange. For incredible optionality. Banking exits are everywhere. PE, hedge funds, corporate development, VC, startups. Banking opens every door. Choose private equity if you want to go deep, not wide. You're drawn to owning and improving businesses over years, not weeks. You're patient. The big rewards come late, but they come big. You have conviction that you can build operational and strategic value in companies, not just advise on transactions. Here's the practical reality. Most people do both. They start in investment banking, spend 2 years building their skills and network, and then recruit into private equity. Banking is the on-ramp. PE is the highway. The path isn't either-or for most people in this industry. It's sequential. Investment banking and private equity are 2 of the most competitive, highest-paying, and most impactful careers in the world. One advises, one owns, one is fast, one is deep, one opens doors, one walks through them and doesn't leave. Both will demand everything from you. The question is, what do you want to build? If this helped you, follow for more finance content that actually breaks it down. And drop a comment. Banking or PE? Which path are you on? Please subscribe.